Hi everyone, this is Matt Curfman from Richmond Brothers with a special edition short update on Matt's Minutes. Today is Wednesday, May 3rd, 2023, and the Federal Reserve just announced another rate increase to the tune of 0.25%, which was widely expected. So they came in as expected, and it was a unanimous decision across the Fed. So we are now in a range of 5 to 5.25% is kind of a target for the overnight short-term lending. So what does that mean? The higher those short-term rates are, that eventually trickles in or feeds into consumer debt products such as car loans, credit card rates, even mortgage rates. And so some of you know this, some of you are familiar with this. As a retiree or as a saver, that's also helping bring up yields on historically safer investments, such as maybe money markets, like through Fidelity accounts, bank accounts, maybe CD rates, things of that nature. And so that is a welcome relief if you're a saver or investor. On the other hand, if you're a borrower, rates getting higher and higher means it's more expensive to borrow the same amount of money when you compare to a couple of years ago. So keep that in mind. It was a unanimous decision, as I said, and this was the 10th consecutive increase since the Federal Reserve began its increased program. We are seeing inflation, according to CNBC, start to come off of the peak, but still not down to the 2% target that maybe the Federal Reserve has outwardly spoken is in their hopes. We've also, in the last month and a half, seen three major bank failures, which were the first in the bank failure space since the 2008 financial crisis. And so that is a concern to the Fed as well, and kind of this cooling economy or slowing down. And then you throw out the word recession, and they talk about, could there be a smaller recession or not a deep recession or a soft landing? Those are just all phrases you hear if you look at all the main headlines. And then according to CNBC, that seems to be in line with what a lot of economists are possibly suggesting. So the thought process as we look forward to the future, as the Federal Reserve keeps meeting, if inflation stays relatively calm, and if there's still some struggles in the banking industry, and if corporate earnings tend to cool down a little bit this year, that probably is more of a sign that the Federal Reserve will stay put or have small increases like today. So just wanted to give you that brief update and let you know this was published, came out of the Federal Reserve on Wednesday, May 3rd. And I know we just sent out a Matt's Minutes video, but I wanted to let you know. From our perspective and for our investors and retirees and those nearing retirement, higher interest rates in the near term will continue to lead to better interest rate on safer assets. And so we certainly welcome that, though it does present challenges economically as a whole because it's made it harder for equities, stocks, mutual funds, things of that nature to perform because it's kind of like there's pockets of uncertainty all over. But the good news is this does not seem to be shaping up to a major recession in our view. And so we want to kind of just keep monitoring this throughout the year. Hope you are having a wonderful start to your spring in May of 2023. We are here to help educate, inform, and guide you no matter what is going on in the world. Thank you so much for tuning in. If you have any questions, please email us questions@richmondbrothers.com. Thank you so much.